Do you really have control of your 401k? It feels like you do, right? You log into a portal, pick your mutual funds, choose your contribution percentage, and watch the balance change. But legally and structurally, you're actually riding shotgun. The employer is driving the car and Wall Street owns the road. When you strip away the user interface, a 401k comes with structural limitations that most people don't fully realize until they try to do something outside the box. First, the paradox of choice. You don't get to invest in the market. You get to invest in your employer's selected version of the market. The company's plan sponsor chooses a limited menu of mutual funds or target date funds, usually 15 to 25 options. If those funds have high expense ratios or mediocre track records, you're stuck with them. Some plans offer a self-directed brokerage account option, which opens up the full market, but many companies don't turn this feature on due to fiduciary liability. Second, the custody illusion. You are the beneficial owner of the assets, but you do not have direct custody. The plan trustee holds the legal title to the assets for the benefit of the participants. Because of this, you cannot simply move, pledge, or manipulate those funds the way you can with a standard brokerage account or a piece of real estate. Third, the liquidity trap. The money is strictly locked down by congressional rules, ERISA, and internal plan documents. Want to move your money to an IRA while you're still working there to get better investment options? Most plans explicitly forbid in-service distributions. You're stuck until you hit age 59 and a half or leave the company. Then there's the loan string. You can borrow against it, usually up to 50% or $50,000 max. But if you leave or lose your job, that loan often becomes due immediately. If you can't pay it back, it's treated as a taxable distribution, plus a 10% penalty if you're under age 59 and a half. Finally, the compliance overhead. Because 401ks are corporate vehicles, they are subject to ADP non-discrimination testing. If the rank and file employees don't contribute enough, the IRS forces the plan to refund contributions to the highly compensated employees to balance the ratios. You could max out your contributions in January, only to get a check and a tax bill in December because your coworkers didn't participate enough. The reality check. A 401k is a highly optimized corporate tax shelter, not a personal investment account. It functions beautifully for automatic, disciplined savings and capturing an employer match. But true sovereign control? That only happens once you execute a rollover into an IRA or transition into self-directed structures where you are the trustee.